Kay, and on this episode of the Note Closer Show, Kenny and I are going to talk about all things lending, financing, and this crazy market we're in.
This is the Note Closer Show, where you get the latest developments in distressed note investing and learn the secrets of how you can control millions of dollars worth of property for pennies on the dollar. Get educated and entertained by someone who has closed thousands of deals and lives to support you in achieving the same. Now, here's your host, CEO of We Close Notes, Scott Carson.
All right, everybody. Hey, welcome. Good morning, good afternoon, good evening. Welcome to this episode of the Note Closer Show, everybody. We have got a twofer today for you, and I will tell you this, it's probably not an episode more relevant with the craziness in the real estate market, specifically the mortgage markets. And we've got some of the best of the best when it comes to residential and commercial finance here on the Note Closer Show today. I'm really excited to have Krystal Moore. She is the founder of Pacific Shore Capital and San Diego's leading expert in commercial financing and real estate investing. She's been in a career of over 19 years. And then opposite of her, we've got Kenny Simpson. He's the head of the Simpson Team at San Diego's premier residential financier and real estate investor. He's worked with over 1,000 clients on all sorts of stuff. So got two experts that have their thumbs on the pulse of the craziness of the market. We were visiting a little bit beforehand, but we are so honored to have you guys, Kenny and Krystal, K and K. We have a double barrel of financial questions today for you. Welcome to the Note Closer Show, y'all too.
Thanks for having us.
Nice intro. Thanks for having us. Appreciate it.
You know, I'm available for bar mitzvahs, birthdays, and weddings if you ever need me to introduce you somewhere. Okay?
Well, yeah, you know, if this doesn't work out, we know where you'll be. So, yeah.
Exactly. So it's a crazy market out there. Rates are going through. Let's talk about some of the changes that you guys have kind of seen, because it used to be, cheap interest rates and, and I won't say anybody could fog a mirror. It wasn't like it was back 15 years ago, but let's talk about it. And let's hit the residential. Let's do the commercial market first, Chris. Let's talk with you how that's kind of changed in the last recent days.
So it's interesting, right? Because most of our commercial rates haven't really changed much over the last few years. A lot of our lenders are banks in Southern California. We just have really good financing. So we're not really doing a lot of agency debt. And our lenders kind of just change rates maybe once a week. Some didn't even change for 2 years. And now it's like daily, sometimes multiple times a day. So it's been super volatile in terms of rates recently. So we're seeing rates are going up even as treasuries are going down. Lenders are increasing their spreads. So that's a big question I'm getting all the time from clients. Oh, the treasury dropped. Did my rates go down? No, in fact, they just went up a little, so that's what I'm seeing right now in the market. And it's causing a lot of, price negotiations on deals that are already in escrow and, people backing out, some sellers are realistic, other ones aren't. So there's just definitely been a lot more change than we've been used to over the last few years.
And I imagine you've seen, let's talk a little bit, because I think most folks that haven't ever taken out a commercial loan, it's a different process than a residential loan, right?
Yes.
You're looking really heavily at the cash flows. You're looking at credit, which is always a big thing. But what are some things that you're looking at on the commercial side for a good borrower, hoping that a borrower can qualify?
So in terms of like qualifications for borrowers,
Yeah.
So I always say my business is so much easier. I mean, when you get a commercial loan, we're assuming that you're a savvy business person. So these are technically business loans. So the kind of key 3 things that I ask for when I'm qualifying someone is I'll have them give me their personal financial statement and their real estate schedule, but I'm going to look at what's their net worth. So their net worth needs to be at least equal to the loan amount or greater. And then I look at post-close liquidity. So after your down payment, after your closing costs, most of us lenders want to see about 10 to 15% of the loan amount in liquidity. So if you come to me for a $1 million loan, you need to have about 100 to 150,000 of cash or cash equivalents. That does not include your retirement most times. So if you have some mitigating factors, I like to say that we're common sense lenders, not so much like residential.
I got the look.
If you're listening to this, she just gave him the look. Exactly.
Yeah.
Like, craziness. But we all understand that. But Sorry, go ahead, Krystal. It was
And
funny.
honestly, credit wise, we don't even really have like a minimum FICO. Like, residential, you might have a, different rate if you have a 720 score or 740 score. We don't really look at that. Again, we kind of use our common sense. Like some of our real estate investors are super active and they might have like, a tenant eviction or some like kind of thing on their credit that's giving them a ding or like some little thing here or there. So we just look at your credit, and the overall like credit worthiness is more determined on what your credit looks like, not just a number on a page. So that's mainly what we look for in terms of qualifying.
Now, when you're looking at the asset, are you guys, we look at
All
what's
cash
happened,
flow.
all cash flow. I know, and you're looking for what 1.25 and debt service
Usually,
coverage.
So multifamily, it's 1.15 to 1.2. And then if you're going commercial, like office, retail, industrial, it's usually like 1.25 to 1.3. And I think that's the biggest kind of crossover that people need to make when they're trying to go from residential to commercials. They call me and they go like, well, what LTV can I get? And I'm like, well, you can get 75, but if you're in Southern California, good luck. Like this is all debt coverage constrained for the most part. So
Right.
I usually tell people the lower the cap rate, the more money you have to put down. So if you want to buy by the beach at like a 3 cap, you're probably putting like 60% down. That's all it cash flows for. But the good news is the bank's not going to let you fail because they're making sure that the property covers the debt. They're buffering it with vacancy factors and management fees, even if you self-manage, and replacement reserves. Like they have all these little buffers to make sure that you're safe, which is not something that you get with a residential loan.
Yeah, exactly. And, I want to come back to that point where you said, if you've got great credit and a lot of stuff, you could get 70, 75%. But most of the time, you're probably seeing something banks usually want to be in 60s of value or less, correct?
It's all debt coverage constrained. And so but it's kind of interesting though, because we're part of, some groups that invest nationally, and we also lend in other states. And so some of these other like Midwestern states and things like that, you used to be able to get 80% LTV all day long, but cap rates are compressed everywhere.
Yeah.
So we're kind of seeing like 60, 65% loan to value is all anything's qualifying for these days.
Yeah.
Yeah, it's such a direct relationship with when your rents go down or the interest rates go up, your cap rates go down, and reduces the value of the property, and that's where the banks don't want to be leveraged above that. We see that a lot with the debt that we're looking at in buying. Is that it's usually, they may have been at 70, 75, but with vacancy and things like that, now they're calling due. Want the bank or the bar to come to the table with 10 grand or 10% cash or 20% to write down that loan to stay that percentage. So. I don't know if you're seeing a lot of that with any of the loans that you've done in the past 2-3 years or anything like that, or heard about any of that.
It's mainly flippers and syndicators because they're doing all these like bridge loans and stuff like that, which have been very popular. We've done a ton of them. And that market is like, it's not really that attractive anymore. I mean, you can just put a little extra money down and get a much better rate nowadays. So I'm actually seeing those guys doing more like a 3-year fixed type of deal. And that's sort of like your bridge financing now. But those guys are having to come in with cash because they get really good reputations, right? So they're super active. And then they have like these private money lenders that are lending them 80, 90% loan to value. And then they go to refi and they can't qualify, or the lender wants seasoning, which is a whole other thing lenders are looking for, So if you bought a property 6 months ago, you can't get new value. Even if you've increased the value, 50% or something, they might say, hey, we want you to keep some skin in the game. So we're willing to lend you 85% of your cost plus any renovations you've done. So that's when we see people having to come in with extra cash.
Yeah, that makes a lot of sense. Now let's flip it over the crazy world of residential stuff there for you.
Here we go. Hold on tight.
Yeah, exactly. Hold on tight. You have it's been much more of a roller coaster a little bit. Is on both sides, residential, commercial. But what are you seeing on the rates and mortgages and cancellations? Is it as bad as social media and the media portraying it these days?
I did read that statistic about the cancellations. And I just think that's just the psyche of the buyer, right? I think the problem is I think a lot of us are learning, like, if we didn't really understand how markets worked and how money worked and what inflation means and how fast things can go up and down, I think we're realizing like what that really means to the stock market or crypto market or housing market or all this stuff. Right. And so, and I think I tell people, we have the R word saying recession, right? And I said everything lags. So I feel like when rates kind of went up, most people, we feel in our business because it's boom affecting right now, but a lot of people, general public, they might not really feel it. And now you're starting to see the effect right now, because they didn't just go up yesterday, they went up months ago, and we're starting to feel that effect. So, and I kind of explain it now because we're getting asked this question. It's like, we all know it's like when they want to, lower rates, give money to people, it's money in the system and money out of the system, and they are just yanking money out of the system, and nobody's getting, the free hamburgers, the free rents, the free massages, whatever you want to say, like joking, right? It's over. You got to pay your bills. And then they're raising rates. And so, of course, I told Krystal and them, I said, 2022 is going to be the challenging year, because I knew this was going to come, but nobody predicted this high. And so we do month over month webinars in the beginning of the year, like I think it was the NAR predicted the highest at 4% rate by the end of the year. Well, we hit that like the second month of 2022. So Here we are. Yeah, I mean, I'm not really seeing the cancellations here, but I'm hearing about them all over. I think a lot of them too might be at the builder level too, where people are like, you know what, I'm out. And I think, but what I am hearing is a lot of people saying, I'm not going to do this remodel. I'm not going to buy this. I'm starting to hear a lot of things in life where people are like, I'm going to wait. And so I can imagine if the biggest thing you're going to purchase is a house, you might wait and see. But just like anything, the refi market, you're only refining if you have to. It's pretty much a divorce, a breakup, a death, get a partner out, or you're just like, I'm going to go get some capital out. So I know I'm going to pay a higher rate, but I'll refi when it's lower to deploy that capital and make money on it. But otherwise, it's pretty much all purchase business. And, obviously, I think what I tell people now, I don't know if it's like, today until when they announce QE, but it's becoming a buyer's market, right? Yeah. So if a house is listed for 500, you used to pay 550 and have a wrestling match to get there. Now it's 500. I'm going to offer you 480 and I want a seller credit. That's kind of what we're seeing, right? So that's the difference.
That's what I was going to ask you, because San Diego has been famous for having this disclosure in the listings that appraised value will not dictate final sales price. You got to bring 25, 50, 100 grand to win the bid, and that's cash out of pocket in a lot of cases. And we've seen that here in Austin a lot, with a lot of California folks cashing out, moving to Texas, buying 3 times the size of the house for a third of the cost. You know what I mean? Here in the last several years here in Austin. So Austin's such a great, we call it Austin's California East. Yes. You know what I mean?
That's what I've heard too. It's like San Diego in Texas.
Well, it's funny because there's an article, I don't know if it's the Real Deal, whatever, they came out, they're saying Austin is so many people went in there and overpaid. They're expecting a bigger correction just because of it. And I tell people it's because somebody went in and the house is listed for 2 million and they're like, what, look at what you get. This is a deal. I'll give you a 2.8. They don't even care. They came from California with, all this money, right? I mean, you're living there. I mean,
yeah, we've seen our house just skyrocket like 35, 40% in the last 2 years appreciate. I'm like, okay, this is just stupid. Now, you guys have both been around in lending since before the last time. 6% interest rates, that's actually pretty good, compared to what it was before 2007 and stuff like that. And you think about this stuff, people are all, flipping out. Oh my God, it's not 2%, it's 4%. Like you said, well, it's still cheap money when you figure out how everything works out, right?
Yeah, it's still cheap. I remember, 2005, 6, like I was doing 6.5% loans all day, and those were good rates. I mean, that was a good rate. We just got used to things being pretty much free for the last few years. So it feels expensive. Yeah.
The first loan I did was for my parents, and they had like 11.5%, 12% back in early 2001. And I was like, you haven't refinanced yet. Like we can't. I was like, oh, let's do a cash out. We got equity. Let's roll everything in there and save you $1 million on there. So let me ask you on this. Are you seeing, and this will probably be a little bit different, Kenny and Krystal, and I'll keep this to you, Krystal. Are you seeing any portfolio lenders out there that you probably see this more on specific asset classes like apartments or self-storage or things like that? But are you seeing any portfolio lenders that have had different requirements than what your true brick and mortar bank are offering up these days?
Yeah. So we've got a couple like relationship type banks that will do a lot more for you if you're a very well established owner and you've got deposits with them. They'll still do more for you. It's probably more conservative than it was, but that's one of the things I love Southern California is we're kind of like a small business relationship type community. So if you have a good track record, you're going to get something, better terms from a private bank. If they more understand your story, they believe in you, they know your track record, you're going to get something more than just like somebody off the street or somebody just buying their first deal, for sure.
Right. Now, Kenny, on the opposite side with you, are you seeing a lot of alt A, or I wouldn't say subprime, we call them non-QM, non-prime loans. They got rid of subprime loans, but we all know they've been around there for you. You've seen a lot of changes in that take place. A lot of lenders really tightening up their product packages for that stuff.
I don't think they even have to do that because the rates are so high. It's honestly, I literally funding a deal right now. Krystal knows the deal. It should have been a non-QM great. 6 months ago, he got a screaming rate. It was better for him to go private money.
Wow.
And it's getting to the point where depending on your deal, we have this is kind of what's going on. And just to kind of like in this industry, and it's like what Krystal said is the banks for her, they get to hold the paper, they put on the balance sheet, they can sell it at a later time. For us, you got the Fannie and Freddie and those rates have come down a little bit, but then the non-QM space, primarily everybody just takes it and sells it on the secondary market, right? When the rates, and I even went to them when rates started ticking up with Fannie and Freddie, there was this little gap between non-QM. And I remember going to Krystal and I said, I go, how are you guys so close to Fannie and Freddie? Like if I was you're buying notes. If you're going to buy a note, I'm like, I'd rather buy the full doc than this thing if it's this close. Well, when rates came at Fannie really quick, the non-QM was like, I don't know if they were sleeping or on vacation, but they let it sit there for a couple of weeks. And all of a sudden somebody went out to the market to sell like $100 million that they do. And they went there and everybody's like, we're not buying this. There's no buyers. And that sends shockwaves. Literally the rates went like 2% within a month. It was, and it killed everything. So the high rates with non-QM are really killing it because it's making it harder to qualify and this and that. I would say they're getting a little bit more aggressive in areas like, they're starting to accept vacation rental income. So if you're buying a property before, like, we don't care, we want to see a history. Now they're like, okay, there's a lot of people coming for vacation rental. So if you can go get a rent survey on the property to show vacation rental, they'll use that. But I think what we're seeing for me is luckily we're a broker. We have some really good relationships with banks that can portfolio the product. So I'm able to do for investment properties, have some really competitive 2 to 4 financing that's ARMs and stuff that's really helping clients keep way below market. But like I mentioned, we have other like DSCR lenders that are banks and they're balance sheeting it. So if you qualify, we're seeing significant lower in the rate. But otherwise, if they have to sell it, that market, nobody wants to buy cheap money paper. And everybody's like, I don't understand. I said, look, there's just no buyers at 6%. They want 7 or 8 yield. It's crazy. But until things change, that's where they're comfortable.
Well, that's pretty much the minimum aspect of it. We want to see it make it an 8%, because it costs us to raise capital to buy that stuff, and that's usually a break-even point unless it's a hugely distressed asset that we can pick up at 50 cents on the dollar, make our money on the back end. But I love the mortgage markets. It's such an interesting. It's almost like General Hospital, or it's a soap opera in a lot of cases. In a lot of these
yeah.
You know what I mean? Where do you, and I'm gonna throw this to you, Krystal, where do you think in the next 24 months, what area of your lending or what area of the clients that you work with are going to be the most impacted in a derogatory fashion?
That's easy. Retail and office. I think those are the two spots that we're already seeing. And I think there's opportunity, at least here, like in Southern California, where there's no land to build. So what are you doing? We're starting to see more people converting office to living spaces. And I think it's such a genius thing to do because we're notorious for being so difficult to get plans and permits and build. It's so expensive. So why not take an existing structure and convert it into residential? And I think that's where the opportunity is. But for sure, I think industrial super strong, multifamily is always strong. It's office and retail that really get hit the hardest.
Yeah, I'd agree to that there. We've seen, especially we saw some deals that we were looking at was office, like executive office turned into self-storage. And
Yes.
it was just full of office furniture from other offices that were closing down. You know what I mean?
Yeah. I also think too that like these class A apartment buildings, like these luxury apartment buildings, like it seems like fancy and fabulous to own these things, but they operate at a higher vacancy. And like, when you can't get a 2-bedroom here for less than $4,000 a month. I mean, what's going to happen when the economy turns? People aren't going to be able to afford to stay there. So I'd be really nervous if I owned some of those luxury buildings. For sure.
Yeah. And then we big box stores with retail office hurting. You're seeing a lot of we've seen conversions of that to self-storage facilities in a lot of cases, or the
Smart.
pods. Yeah, smart.
Self-storage is another super strong sector of real estate for sure. It's like people pay tons of money just to store their stuff that they never look at for years.
And then they walk away from it, and then you just sell it all. It's like it's honestly like an unbelievable business.
Yeah, with only roughly a 30% expense ratio compared to 45-55% in multifamily. Yeah, we got a friend that owns a couple thousand units, and she doesn't even have any on-site maintenance. It's all done like ATMs and virtual these days.
Wow.
Smart woman.
Smart woman, exactly out there. Now, where do you think you're going to see the biggest impact on the residential side for you, Kenny? And is it more of probably a price range or areas out there? I mean, San Diego's always been hot, but are you going to see more stuff in the outer areas because people want to live downtown or live in San Diego? The San Diego still going to be the demand for it?
Yeah, it's a great question. So since I studied the data now, and because everybody's like, we're always go back to where we were scarred, and we were scarred from the 08. I think everybody, right? We always like, whether it's a relationship or this, like, remember the time you screwed me over? It's like that. And so you knew that. So when I go back and I just look at the data, and I'm like, everybody's like, well, how is it different than then? And I was just curious. So it's great. We can go look at data. So if you take San Diego, like before the last crash, let's just talk numbers, right? There's 27,000 active, listings on the market. Today, I think we looked, there's 5,000. So we're still, lacking inventory. The profile of the borrower, as was, the heart-beating pen loan. You just had a heart-beating pen, we'll give you a loan. Today, that's not the case. So we're making better loans. The average credit score is much higher. And then right now, I know it's because COVID and they're doing the workouts, but I always tell people, I really believe that banks are working things out more these days. They're not in the business of foreclosure and short sale. That was a disaster for them. And the other thing that nobody talks about that I really believe is when somebody, can't make a payment on their car, this or that, and they become, their credit gets ruined, they're just like, they're not a consumer for a year or two. They can't get credit. They can't spend. And most people, when they buy anything, they use credit. So, and I think we learned from that saying, isn't it better to try to work them out or say, go sell your house? And I think one thing I think they did with the pandemic, I know it sucks, but they did go back to the banks. It's like, we bailed you out. It's time to kind of like, this did help because you would have had a nightmare of a situation. So the point of that is just take 2012. And I was looking at data, the foreclosures and short sales were 35% of the market. Today it's 1%. So, and people have more money, they're more prepared and stuff. So when I look at the bar and I'm like, okay, where is this going to be? But I do think, again, like you said, I think people went and they bought in outlining areas and the market was really hot and they probably overpaid. And you're like, who would buy a house out here for $750,000? There's nothing here. Those people will probably get hit first if it goes down and then it trickles in. But otherwise, it's really, I think, going to be a matter of inventory. Like, is there going to be more where you guys are? You're going to get a bunch of inventory. And I think the sellers today are, I want to try to capture before if there is more of a correction, or I just want to get out and, maybe cash out or move somewhere else. Or the third is like, I have to sell because of some situation.
Yeah.
But I see the people that might have got hurt, that put minimal down, that went out in the outlining areas, but hopefully they locked in on a good 30-year fix. That's the thing, is 75% of people have a 4% or less rate. And the ARM rates, the ARM products, I think around 2 million, 3 million people have ARMs. Last time there was 13, 14 million ARMs. So when you look at the data, you're like, people are in a better position, but you and I know, like, if people lose their jobs and stuff, they're going to walk away, but I think it's going to be smaller. So yeah. I think certain markets are going to be worse, but I think the outlining areas are going to be like where they're going to have problems, where people went too far out to overpay for a house.
Well, and I think you also, too, people don't necessarily want to sell their house to cash out because they can't especially if it's not a huge cash, they can't go anywhere. They can't go get a lease because they've got bad credit. They don't have the extra to put down. They can't qualify for 24 to 36 months for a traditional loan at that point. So people always say, well, they'll just sell their house. Well, that's not always the case. They may not have a place to go, but you're right. I mean, with so many of the forbearance agreements, and we see that as note investors, banks don't want to end up owning the real estate. They would rather sell it off to somebody else and go out and rinse and repeat, velocity of capital, go out and make loans again on that stuff. It's fresh, clean paper, and let somebody like me be the bad guy of having to foreclose or anything. And I don't mind it because we're seeing deals 6 to 12 months ahead of when most investors are buying the REOs or hopefully the short sales. That's why you don't see that much stuff, because it's already been worked out because somebody stepped in and gave the borrowers an opportunity. You know what I mean?
I think you're also going to see too, so kind of towards the end of the last recession, you started seeing, especially in apartments, like people would always ask me, how did apartments do? And I'm like, honestly, we're fine. Like rents didn't really go down that much. I saw a lot more people like bunking up, like family members living together, and, people living somebody sleeping in the living room and 2 people are sharing the bedroom and all that kind of stuff. So I feel like, if things get tough here, that people are so much smarter, and there's so many more things now. Like you can vacation rent a part of your house. Like you can get a roommate, because you're, like you said, if you locked in a 3% interest rate, you're like, well, I'm stuck here. So now I'm basically going to be,
out. Yeah.
I'm the person in the family who everybody comes to move in with because, I got the good rate and I need the cash. And, so I think people are a lot more prepared and smarter and got good rates and good loans, and they're just going to be stuck. But that's not the worst case scenario.
Well, that's a great thing. You got a low interest rate. It being stuck right now in a volatile time frame where you're still able to afford things versus somebody who's got an interest rate that's quite a bit higher, 3 times higher by the end of the year. Who knows? You're in a much better position, even if you lose out on some of that equity with prices coming down. You're still sitting in a great position to ride it all out. I mean, that's what we love as investors, is to ride stuff out and cash flow as best you can. Yeah.
Exactly.
So let's take that. Let's talk about your investments. Let's talk about what you like. What lights your fire as investors. And then we started first with Chris. We'll go to Kenny this time. Kenny, what's your favorite thing to invest in and where at?
I mean, honestly, I think we're just like the bread and butter is multifamily. It's as Grant Cardone would say, it's not a get rich quick, it's a get rich for sure long term. Yep. We've been really fortunate here. I mean, because Krystal does the commercial financing, but we know a lot of people that, over time they just built a portfolio, and it's not sexy, it's not fun, it's not shiny and flashy, but it's consistent. But obviously I think there's that opportunity. And then, we'll see what the market presents too. Like, there might be opportunity to buy some distressed homes or stuff and flip them. But also too is, I definitely think crypto and stock market is very much on sale. I think we just have to see how much carnage there is. I think, the feds will hike one more time, but and then we'll have the recession. But I think there's going to be a lot of opportunity if you have cash to deploy it in the next 12 months for sure, and make a lot of money before, and then they're going to hit the QE button and we're going to be right back at where we were,
Sure. Krystal, what about yourself? Very similar? Or?
Yeah. I have had the privilege of looking at a lot of very successful people's tax returns. And I always joke that like apartment investors look like they should be living under a bridge somewhere, because like somehow they like don't have any money on there for their tax returns, it looks like. So I saw like their lifestyle and how they live, and multifamily has always been my bread and butter. Like Kenny mentioned, we kind of shift within that industry for sure. So look, flips and rehabs, renovations were all the rage. We were doing that when it was hot and it was super safe. Like, we were doing that and kind of trading up to build our portfolio. And then, Southern California right now, ADUs are the big thing, like an accessory dwelling unit. Yep. Now on multifamily, you can add multiple. So we look at those as opportunities for us to add units to our buildings, like with fairly low building costs and not as much, red tape and all of that. So within the industry, we just look at where we can maximize, because I will say, I think, multifamily used to be more profitable, but now it's become like the super safe vehicle. And, the more safe you are, the lower your return is. So we have to get more creative to increase our returns through adding ADUs or renovating or adding other streams of income, cutting expenses. So that's what I love to do. And then of course, Kenny dabbles in the stock market. It's not my thing. We've invested in some other businesses through some of the other groups that he does, but I would say like the majority of our investments are multifamily, and that's where I know it's safe and I'm never going to lose. And I feel super comfortable and very confident in that space.
Now, are you guys buying there in San Diego, or are you looking at other parts of the country?
Yeah. So we started looking about a year ago, like out of state, because, I was looking for higher returns, but in doing that and outside of like, maybe if I was from a small town and I knew of like some niche space, like I looked in Florida and I looked in Texas, and we went to Florida for a month and I drove every single listing up and down like the east side, the East Coast and most of the West Coast. And I found that the cap rates were super compressed. I was like, I can just invest in my backyard.
Yeah.
If I have a bad management company or something, I can take the property back. I can search for other people. Like it's so much easier for me. So, and the one thing that I've learned is as much as people who are out of state, like say, stay away from California. It's not landlord friendly. It take forever for you to get a tenant. You'll lose all your money. That is not the case. We have much higher appreciation than most major metros and areas. So our appreciation alone is huge compared to investing out of state. And if you do it right, you can actually get really good returns. I know some of the investment groups I'm part of are always shocked. Like I'm getting a 9% return on a property we bought a few years ago. I'm like, yeah, it's actually possible. So I love Southern California.
Are you guys buying big? What you would say your average unit number is on the stuff that you're buying?
15 to 30 units. It's because it's gotten more expensive. Yeah. And the one thing is what we learned is when we went to these states, we were kind of like talking to brokers, like, so who, how many offers, who's the buyer? And what we learned is they're like, oh, the buyers are international all over the state, this and that. And you're like, what? So they're like, and I go, who's your buyers there? We're like, well, if there's a listing, we can probably tell you who's going to buy it here because we don't have the outside competition. So we're kind of shielded here. And, we talk to these syndicators, we interview them, and they're just kind of like, you might just stay there too. I might do the same thing. Like if it's working, if it's not broken, don't fix it. Right. So
yeah.
Go ahead, Krystal.
Here where you might have on a super competitive deal, like the last few years when it's been really hot, you might have 8 to 10 offers on a deal. Whereas out of state, I was hearing like 30, 40, 50 offers. And you're like,
on a massive buildings. Yeah. It's insane. It's insane. Yeah.
Well, I think you've got a strong niche because I always say you have everybody chasing 100+ unit developments. You know what I mean? And I think that small target works really, and you got a ton of them in San Diego there. I mean, one of my first note deals was buying an 8 unit and a 21 unit note deal off of Mansfield, just off where what I'm talking about up there, just off of on the north side of San Diego.
North County.
Yeah, North County, exactly. And it's you have streets of it, all of that 8 units and 12 units and 15 units and stuff like that. And I mean, they cash flow great. Yeah, you're gonna have a higher return on that stuff. And it's also great because you can often have one management person manage multiple assets for you in a lot of cases too, right?
I would love to take any apartment building, like buy any apartment note here in San Diego, because it's like you're not going to lose no matter what, not even a chance.
No, we were buying debt at 50 cents on the dollar with equity, 50 cents of the balance, and there was still equity above that back in the day.
Wild.
But here's the thing, I think, and I'm going to ask you this because you've probably done some. Because a lot of these apartment investors out there that are chasing those 100 and 200 units, their biggest goal is to refinance out in 24 to 36 months.
Yes.
I don't think those loan programs are going to be around that they're expecting. What do you think, Krystal?
No. And that's what I'm seeing a lot with syndicators. Cause like the kind of thing I joke about now, like everyone's a syndicator, you're going to a real estate broker to buy your apartment building and he's a syndicator, also, and so the problem is all these guys are giving these forecasts, their investors like, hey, within 3 to 5 years, you're going to get all your money back, and through a refi. And I'm like, I don't know that that's going to be the case right now. I mean, also with rates going up, it's just kind of interesting. It's hard for me to fathom where rates are going and then where cap rates might be, because I'm like, how have like, today, let's say a 4.75 rate, the cap rates are still at 3.5, like, and then, rates are going to go up to 5, 6%, 6.5%. Are our cap rates going to go that high? It just doesn't seem there's too big of a spread. So I'm like, how are you quote pitching this to your investor when as an owner, I'm happy to get like a 6 to 8% return. And somehow you're going to give them a 8% return and 100% of their cash back in 3 to 5 years. And you're going to take a 20% split. It's like, how is this all going to work out?
Yeah, no, you're speaking my language. As I see that, I'm like, you can wish in one hand and actually have it happen in the other. We know what's going to happen there for a lot of folks, because history does repeat itself in a lot of cases. We've talked about kind of where some of the different opportunities, but by the conversion system and stuff there. San Diego is such a unique market compared to other areas out there too. And growth has just exploded in San Diego too, in a lot of cases out there. What outlying areas do you think are maybe not the overlooked diamonds in the rough? Oceanside used to be just a sleepy little mobile home community a few years back. Now it's different. What areas do you see a lot of opportunity for those out in Southern California that might be opportunities to be invested in for folks?
Well, I can tell you, we love National City here in San Diego. And it was kind of interesting because I was just talking to somebody about this the other day is, in the last recession, Chase, who's like the big apartment lender here, stopped doing apartment loans in National City because that was the only part of San Diego where they took back any properties.
Yep.
And now it's like National City is like the next up and coming area, I think, too. You just have a lot of owners who've never sold their properties. Property taxes are super low. The city's trying to increase that, and they want to encourage building. They're very easy to work with. So I love National City. But there are a lot of outlying areas like Ramona, and, some of those areas are like, you can get the highest cap rate in Ramona. We're doing a few deals over there right now. Like I saw a 5.5 cap in Ramona. I'm like, if you can get a 5+ cap anywhere in San Diego, that's fabulous. So, and you still have high occupancy and, all the good things that you get in San Diego, but it's just a little out there.
Yeah. I mean, San Diego, we say we have the 4 walls, which is, so we got Pendleton to the south,
To the north,
the ocean to the west, Mexico to the south, and you have the mountains to the east. And so we're really locked in here. But I'd say Krystal kind of nailed it. I would say, the core areas are really expensive, but they're honestly, if you can get deals, there's a lot of upside and opportunity. People that love Southern California, they just stick here and they just they like regurgitate their money here or something, right? It's like cash out. They just love it and they know. And if somebody's been here for 20, 30 years or 40 years investing, the amount of appreciation, like you said, they made, they're not going anywhere. And some of them have dabbled outside. They're like, yeah, I'm not doing that again. It just didn't work. But I would, piggyback on Krystal. I agree those areas, but also there's the whole 78 corridor where there's Oceanside, Vista, Escondido, that
Vista for sure.
Yeah. San Marcos is on there too, right?
And a lot of young families move out there because the bang for your buck is better. But the closer you get to the water, it's like kind of forget about it. But if you can buy a deal and get a license and do vacation or something, you could do well, but it's tougher by the water. I think water, we have clients buying there, but I think because they have a lot of money and they're selling out stuff where they don't want to be anymore. And they're like, this is legacy assets for my kids. I don't even need the money. Let's just deploy it and buy near the beach.
And also the thing with San Diego too, is like the biggest comparison is it's still a pretty good deal here. I mean, even though it's so expensive, people coming from San Francisco and LA, they're getting a ton of bang for their buck here in San Diego. They love it. The weather is better. It's not as much traffic, all that kind of stuff. It's a lot more laid back. Like, I mean, people here come to work in like, board shorts and flip flops. Like this is like a very kind of chill place, and it's still very affordable by California standards.
Yeah, it really is. Yeah.
Do you still have the weird, you may or may not know this, or if you're down like Oceanside or PB or Mission Beach, where if it's, we saw a lot of places that where if they kept one wall up, it was one wall, it was a rebuild, or it was a rehab, not a new build. You still have that kind of weird.
We still do, because Coastal Commission is rough. Like we're in like La Jolla area, and they're saying it's like 3 or 4 years. Just like don't even think about it if you're going to build a house. If
you want to build an ADU there, it's like everybody gets to give their 2 cents. It's unbelievable. Like the Coastal Commission is, we're going through where. This year we are La Jolla Shores. They put the restaurants out there and it makes sense, but they're just, we're just waiting for the Coastal Commission to give us approval. It's like, what takes a year? It's so here we have that. And it's like Krystal says, building in our neighborhood, It's one guy's been building a house for 10 years. He got 2 homes, not literally 10 years. I looked it up. I go, this is exaggeration. I'm like, no, he bought them in 2010. It's 2022. It's a monstrosity, but it's like he's building it, or it's a 4 or 5 year project. And this is what I tell people.
That's the fastest, probably.
You can't even, even if you wanted, you couldn't build here. Like she said on a panel with a lady, they do $500 million of building multifamily and stuff throughout California. She goes, we do 2 billion. You just can't do it here. It's a joke. Like we're the best at it and we can't even move fast. So that's I mean, it's good for owning apartments because there's rent demand always, but it's bad because rents are high. It's too much, you know?
That makes a lot of sense there for you. Now, Krystal, are you seeing on a lot of your commercial loans where they're allowing assumable debt to take place, where the loan can be assumable to somebody later on for the most part?
Oh yeah. The majority of our loans are assumable. And honestly, it's never been a thing. I've very rarely seen assumptions, but I think we're going to see more of them, now because people are locking in really good rates and that's probably the best debt they're going to get. So I think right now assumptions are going to be very valuable for people buying properties. But yeah, in the past, it has not been because everything's like max leverage, rates are lower, but now it's like, I have clients that are doing loans right now that think they might be selling their properties soon. And they're like, I'm just going to do the loan with you because if I don't sell it, they can assume the debt. This is the best debt they're ever going to get. And so I'm safe either way. I could sell the property, have them assume, or I can just lock in my debt and make sure I'm safe if something happens.
Yeah, that makes a lot of sense. It's common sense there makes for folks to take advantage of that stuff there for you. Now, there was something I was going to ask you there. Oh, I know what it was. With your focus, what would you say? What would you say the median home price is roughly there in San Diego right now? If you're looking at the numbers, it's like $1 million plus, or
it's $1 million.
Think between condos and everything, it's like 860. But when it comes to houses, it's like over $1 million.
Yeah. Wow. And that's a whole different qualification because that's a jumbo loan these days. They adjusted jumbo loans just basically.
So here's the interesting thing. So, there's Fannie Mae, there's conforming and high balance. High balance in LA, I think is 950. So you could put 5% down to 950. So just, here it's 860. So you buy $1 million home and just put the 15% down and get it if you want. Yeah. The thing about, like Krystal said, the great thing about California is our lending here is, I don't know if it's better anywhere else. I can't say anywhere, but it's like, there's so many banks. People love to lend here. They love the property. They know the equity. So there's so many options. It's funny because when she goes and talks to apartment people, they're like doing all Fannie Mae. We're like, no, we just do bank debt here. No yield, maintenance, prepay, none of that nonsense.
Well,
nobody wants to deal with it.
In other states, like we see out of state, it's like standard for multifamily to do like a 20 or a 25-year amortization. And here it's like 30 years all day long. Like, so if you get nothing else, I think you get the lowest rates here and you get the longest amortization. So it just helps you out with cash. It's probably what you need here. Unfortunately, that's why they do it. But you get the most aggressive financing here for sure. And the most options.
Well, that's speaking of options, we'll come back to stuff, but that's why I think we started to see such an increase in the birth of the 40-year amortization for residential, or even 50-year. I saw modified for a loan for 50 years. I'm like, what the hell were they thinking? But it takes me back to on the origination days of the product that I think had more impact on the residential markets. The whole pick and pay, the option arm.
There you go.
Yeah. You know what I mean? The pick and pays were great. 1% interest rates, partial interest payments, as long as you kept the appreciation side. But when appreciation stopped, the whole dream stopped for so many folks out there. Do you see appreciation? I know we touched on it briefly, slowing down anywhere there in Southern California?
No, for sure. Yeah, I think appreciation is definitely slowing down. We're seeing the price reduction. So, but people are also were like trying to chase a pipe dream price. And so you're seeing a lot of cuts where I go, people are like, well, if it's priced right, you don't need to cut it. It's people that say, well, Mary next door sold it 3 months ago for this. It's like, well, that was 3 months ago. And she got like, it was a one kind of random deal. So I think people are starting to accept reality,
But also too, the thing that we've kind of been talking about that we're seeing most is in purchases, like seems like a 10% haircut seems to be the thing everybody's getting from the sellers or going back to the sellers for. So those are going to be comps soon enough. And so this is going to kind of perpetuate itself. So I'm seeing not only like some price reductions. You're just not getting the over list. Like I think brokers are having that tough job of having that conversation. They sold the seller on what a hot market it is. And now it's like shifted mid listing and, they're having to manage all that. But so I think we're seeing the price reductions or like the negotiated price reductions for stuff that's in contract, but it is definitely happening on new purchases because the problem is and it's going to keep going because the higher rates go, the less sense every deal is going to make. So when people are calling me for purchases, I'm like, even now, hey, the next Fed meeting's like in a couple weeks. So you probably want to lock that in now. Now's not the time to shop around and think about it and wait and see. It's like, you got to kind of be ready to move quickly.
On your typical commercial deal, what's from the time somebody goes into contract, what are you seeing closing? 30, 45 days, or is it a longer process for you to close in a commercial?
60 is pretty much our standard. We are able to close some deals in 30 or 40 days, but generally we like a 60-day closing. That's what everyone's comfortable with. It's industry standard here.
Yeah. You're seeing 30 to 45 on the residential side, Kenny, in a lot of cases, or?
No, I rarely get 30. I mean, we're closing as fast as we can. I mean, we close deals 5-7 days quick.
Wow.
Yeah, I do. Yeah. We got some great lenders with appraisals. So it's fast. One thing I was going to mention to your audience too, which could be something we could just throw out there as, I think I was going to, mention for commercial and, is when people are getting debt now, a lot of people is, if there's going to be a lower rate in the future, which we always probably know, like what goes up is going to come down. One thing I will say, if you're getting like a DSCR loan, a non-QM, it has a prepay. One of the things I'm seeing is this product just gets pushed out among more mortgage brokers and lenders. As you know, they never did the products. They're like, oh yeah, we got these new products. And nobody ever asked about the prepay. They don't talk about it. They don't understand it. And I know Krystal's that. So what I would tell people is you really have to factor in, if you're buying an investment property or refining something, and you think there's an opportunity to refi in a year or two, make sure you're paying attention. If you're getting a loan with a prepay, I've had people talk about they're going to get a 5% hard prepay, and they didn't really understand it was $100,000 and they can't refi in 2 years. So I would just say is make sure it might be worth to take a higher rate and just get a shorter prepay so that window's open. And Krystal might want to elaborate on commercial too, because even the big guys buying the big buildings, the syndicators, they're also figuring out, okay, we're going to probably get a discount on a building. The product's going to suck the pricing. What can we do? And buy down the prepay. And they're already having these conversations like, what kind of debt can we get? Because we want to be able to have that opportunity to refi in the future. I don't know.
Yeah. On your side, Kenny, it's interesting. I was just going to say, as I was just telling him this the other day, is like his residential lenders are not very clear about their prepays. Ours are like right there on the paper. Everybody knows what it is. It's a discussion, like it's expected, but for him, like it'll just say like, if it says anything, 5%. And I'm like, 5% of what? 5% for 5 years, 10 years, 20 years. Right. Like, what are we talking about here? So you have to physically like go seek out this information, which I think is probably an area where residential lenders might get in trouble in the future with all these people getting these prepays and their loans, not understanding. But it's standard for us. And I think the biggest thing that we're doing for clients up front is just kind of talking to the lender. Hey, if rates go down, like, will you work with me on the prepay if I come back to you? Will you waive half of it? Will you waive all of it? Within what period of time? So we kind of know all this stuff up front. But I also too am like just having people shy away. Like the last cycle, people freaked out and they all wanted a 10-year fix and they thought they were going to keep it forever and rates were never going to go this low ever again. And, I'm like, you're going to regret this decision. Nope, I won't. I know better, and so they got these loans and like, of course, less than 5 years, maybe 5-6 years later, they're like, hey, Krystal, what can I do about this prepay? I'm like, you remember that conversation we had like 5-6 years ago? That yield maintenance, we talked about that,
That's $1 million now. Yeah.
Yeah. Like
there's nothing you can do about it.
Rate environment where, rates are going down, your yield maintenance prepay is just like the worst thing you can have. So I think, I always tell people it's not just about the interest rate. Like people are so rate sensitive. It's like the whole enchilada. Like you need to take that into account. And as an investor, the whole reason we invest is to make money and have some flexibility and stuff. So locking yourself in on a 10-year fixed is just, if you've never even kept a loan for 10 years, let alone 5, even, it's like, let's not like throw it all away now. Like it's the worst thing is to make decisions based on fear. And so people think I'm crazy, but I'm like, I would still do your 5-year fixed, I'm still like, I don't think in 5 years rates are going to be 12% or 14% or whatever some of these people are peddling right now,
Well, if they are, there's a lot of opportunity for us
for sure. Yeah, absolutely.
Yeah.
But like investment properties are meant to be like a fluid, like they're an investment. Like they're more fluid, they're more flexible. So there's very few people that have ever kept a mortgage for that long.
Yeah, I just wanted to bring that up because on the residential side, like Krystal said, it's very uneducated. And a lot of people got these DSCR loans and they locked in these long prepays. And nobody pays attention until you need to pay attention, right? So you need to sell it out. And that margin of let's say you had a 75% LTV and your value went down, and all of a sudden you got to pay this prepay. You might be thinking you're going to get out this money, and then it's problems. So pay attention to what you're signing.
Yeah, exactly. Because you never know because we've seen increased divorce. People haven't been forced to live at home with their spouse that maybe they never should have been. Increased bankruptcies in a lot of cases. And then you also have a lot of folks that bought, FHA loans were at a 14.6% default rate for first-time home buyers a lot of times out there too. So it's crazy out there. So what's the best way for our audience? First of all, before I get to talk about the Getting the Cashflow Game podcast. You guys are the host of this podcast. You do a great job with it. Share a little bit of the audience. Let's have you a little commercial here for your podcast. What do you guys?
Yeah, no, I appreciate it. So, yeah, we started our podcast. I think was it 3 years ago. It was actually called Value Add with K&K, and then we really got hyper focused on real estate. So really, we interview entrepreneurs, real estate, and entrepreneurs that probably invest in real estate and stuff. And we kind of talk about whether it's financing or investing, or we bring different people on that could be a real estate attorney or somebody that's talking about cost segregation or whatever. So really, it's just educating people on what's going on. We might just do solo stuff where we're like, hey, we need to update the audience on just like we talked about today, rates and mortgages and how it's changed. And on top of that, I might do a solo one where I'm talking about like the economy and things like that. And I've really gotten to dive into that. So kind of all the above. And it's just really trying to educate the clients and help out,
Really, we talk all things investments, it's all getting the cash flow game. So we all believe in providing, building cash flow for yourself and all of that. So generational wealth, that's our big thing. So we like helping people to do that. And we started out more local. And as we've grown, we've had more, well-known guests and people from all over. And, it's just cool to hear strategy and give people as much information as we can to help them do the same thing we've been able to do.
I love it. What are your guys' big goals for the rest of the year on investment wise for you?
We just purchased another building. Hopefully we'll maybe pick up another one here. But honestly, we're really focused on, I think right now with the industry is a lot of people are pulling back. So I'm really focusing on more content, building the brand, continue to do the podcast. And then with investment, I think really just seeing what the market does and where the opportunity lies. Maybe I just keep saying, I think there's going to be this short window from where rates are high, people are scared, blood in the water, whatever we call it, the Warren Buffett, where everybody else is fearful, be greedy when they're greedy, be fearful. And it's swinging, right? The pendulum's swinging back. And so I think there'll be an opportunity to where you can buy and get a deal. And then when the Fed comes in and decides we got to lower rates again, they'll probably lower them really low in the beginning to get that stimulus. But then the demand, I think the people coming off the sidelines, it's going to be like a herd of cattle, running over each other. And I tell people you don't want to look back and go, that was the opportunity. Right. Because you think it's when you're kind of uncomfortable, sometimes that is the opportunity. Right. So.
Yeah. Now, let me ask you a question. With so many loan officers and banks laying off mortgage staff and stuff like that, are you getting folks to reach out to you, ask you, hey, how do you invest? Because we know not a lot of mortgage loan officers are investing. They're usually hand them out. A lot of realtors are the same way. You guys are unique, not so unique, but you still do a great job with that and building your portfolio and stuff. Are you getting folks to reach out to you? What should I do?
All the time. We always have, honestly, because we used to have a property management company. I managed over 1,000 units here in San Diego and stuff. So, it just got to the point where clients would be like, Krystal, just do my rehab and let me know how much it costs. Like we would just do everything A to Z. So from the beginning, it's been a long time we've been doing this, and people ask us for advice and how do I get started and what do you think? And do you mind looking at this deal for me? Tell me if you would buy it, So we do a lot of that advisory kind of stuff for our clients. It's something that we're kind of passionate about and we love. Like I know certain people go like hang out with their friends or like play baseball or whatever. We like look at real estate, we drive properties and like go to Home Depot and look at things. So
yeah, and I don't think you're going to meet a loan officer or a real estate agent that is not thinking about investing in real estate and having cash flow. I just think it's discipline. It's hard to live below your means. It's hard to sacrifice. And so the ones that do, I think, they have an exit at the end of their career.
Yeah.
And it's funny, we've met people that are the top producers in San Diego for 30 years, made probably 7 figures for majority of it. And they're like, yeah, we're idiots. We didn't buy. And you're just like, what? And you think they're set. They're like, no, I'll be doing this till I die because my lifestyle and I don't want to give it up. And so we're surrounded by the crew that's does what we do, but they're like, we need to invest. We get it. Cause like Krystal said, we've seen the lifestyle. You're like, do you really want to be slinging loans at 60 or do you want to be chilling out? If you don't prepare, 60 is going to come like that,
That is the truth. You got to make hay while you're making hay. It's time. You know what I mean? Go out there. What's the best way for our listeners to connect with y'all out there?
So you can go to our website. It's gettinthecashflowgame.com. And that pretty much leads to Kenny's residential site and then my commercial site. And then we're on Instagram. So I'm Krystal Rose Moore and he's Kenny B. Simpson, but those are the best places to find us.
Awesome. We'll have those links and the URLs in the description chat. I have to say, thank you so much for coming on the No Closure. This has been a fun episode to pick your brains on where the market's at and where San Diego is going and all the stuff that's going on there.
Thanks for having us. I'm excited to do the podcast swap here in a couple days.
Oh yeah. We'll have a good time.
Yeah. So I'm excited to learn about what you're doing. Yeah.
Oh yeah. All right, everyone. Well, that's going to wrap it up. Check it out. Getinthecashflowgame.com to connect with Kenny and Krystal and get your questions answered. Or if you're looking for finance, you guys do just in California, you're doing outside of California as well, or has it?
He's California and Florida, and I can do all states.
I'm getting Texas soon. We're working on getting Texas licensed in Texas. Yeah.
You know what? It used to be you pass your group 1 and $125 and you were a loan officer here back in the day. Not so much anymore, but anyway, good stuff. Thanks guys. Appreciate it.
Thank you.
Thank you.